EPK Capital presents Daily Brief for 19th and September 2025. Hello everyone, welcome to EPK Capital's Daily Brief video. I am your AI host, Rutvik. In this series, we try and update you and make sense of all the important news from the world of finance that came out globally. So, without further ado, let's begin. The financial world ended the week in a state of fascinating contradiction. On one hand, US markets soared, with the S&P 500 hitting a new record high, driven by a game-changing AI partnership between two technology giants. It was a day of undeniable bullish momentum, fueled by a renewed appetite for risk and a glimpse into a future powered by artificial intelligence. But beneath the surface, the macroeconomic reality presented a far more nuanced and at times concerning picture. The Federal Reserve delivered a long-awaited interest rate cut, yet its message was anything but celebratory. Chairman Jerome Powell's cautious tone and the revealed divisions within the central bank paint a portrait of an economy navigating a precarious path. The day was defined by a powerful rally in U.S. equities, with the S&P 500 closing at a new record high. Data from across the market confirms this positive movement, but a closer look reveals a story of asymmetric gains. The market's enthusiasm was not broadly distributed across all sectors, but was heavily concentrated in the technology and AI space. This divergence suggests a risk-on environment specifically tied to a small number of mega-cap tech stocks, which heavily influenced the Nasdaq and, to a lesser extent, the S&P 500. The broader market's less enthusiastic response indicates underlying caution outside of this dominant theme. This concentration of gains makes the overall market more vulnerable to company-specific shocks, potentially reducing the benefits of diversification that investors assume from broad equity exposure. The benchmark S&P 500 index, .SPX US, advanced by 0.48%, closing at a record high. Leading the charge was the tech-heavy Nasdaq Composite Index, DAC US, which climbed 0.94% and was nearing historic levels. The Dow Jones Industrial Average, DJI US, meanwhile, posted a more modest gain of 0.27%. While the US rallied, global markets offered a more fragmented picture. The positive spillover from Wall Street was not universally felt, with regional factors playing a dominant role. The FTSE 100 in London fell by 0.88%, settling at a value of 9,195.66. This decline suggests that the US-centric AI news was not enough to overcome regional headwinds, which were likely influenced by the Bank of England's decision to hold rates steady. In Japan, the Nikkei 225, den ID a Otnkex JP, also closed lower, down 0.57% to 45,045.81. In stark contrast, Indian benchmark indices like the Nifty and Bank Nifty extended their upward movement for the third consecutive week. This upward movement was driven by optimism over recent constructive trade negotiations between India and the United States. The divergent performances across these global markets underscore the fact that while U.S. monetary policy and corporate news have a strong influence, regional economic data, trade developments, and other political factors can lead to significant market fragmentation. The macroeconomic engine, policy, data, and the stagflation light threat. The most anticipated event of the week was the Federal Reserve's policy decision. The Fed delivered its first interest rate cut of the year, lowering its benchmark rate by 25 basis points to a new range of 4.0% to 4.25%. This was the first rate reduction since December 2024. The move, while largely anticipated by the market, was not a simple signal of economic health. Fed Chair Jerome Powell's press conference provided the critical context. He described the economy as being in an unusual situation and framed the rate cut as a move toward risk management rather than a testament to the strength of the economy. He pointed out a central dilemma for the central bank. Its tools can't do two things at once. This statement reveals the precarious balancing act policymakers face, as they must navigate a weakening labor market while simultaneously contending with persistently elevated inflation. The decision to cut rates signals that, for now, the Fed is more concerned about a potential downturn in employment than a continued rise in prices. The Fed's decision was not unanimous, a fact that signals both internal division and the influence of political forces. The newest Fed governor, Stephen Moran, a recent appointee by President Donald Trump, cast the sole dissenting vote. Moran advocated for a more aggressive 50 basis point cut, aligning with the repeated public statements from President Trump, who has been a vocal critic of the Fed, pushing for more aggressive rate reductions. This divergence is a public manifestation of the ongoing political pressure on the central bank, which can undermine its credibility and create market uncertainty. Powell's need to publicly reaffirm the Fed's independence during the press conference underscored the seriousness of this issue. The market's narrative is shaped by a mixture of forward-looking sentiment and backward-looking economic data, which often presents a conflicting picture. Today's data releases were a perfect example of this. Initial jobless claims for the week ending September 13th fell by a significant 33,000 to 231,000, marking the biggest drop in almost 4 years. This data point appears to directly counter the Fed's primary justification for its rate cut, a softening labor market. However, this is a classic case of looking at different time horizons. While weekly claims can be volatile and show short-term improvements, the Fed's decision is based on a longer-term trend of slowing job gains and a rising unemployment rate that has edged up. Furthermore, the final Q2 2025 U.S. GDP growth rate was revised upward to a strong 3.3% on an annualized basis. This seemingly robust number, however, is a statistical anomaly. An analysis of the components of the GDP report reveals that net international trade contributed a massive 5.0 percentage points to this growth. This was largely an unwinding of import front-loading that occurred in Q1 2025, as businesses raced to acquire goods before the imposition of new tariffs. This means the headline number does not reflect true underlying economic strength. Final sales to private domestic purchasers, a more reliable indicator of demand, grew at a much weaker 1.9%. This is the mirage that makes the economy seem stronger than it is. The inflation problem also remains. The August CPI report showed inflation rising 0.4% on a seasonally adjusted basis over the month, with a year-over-year increase of 2.9%. Nowcasts for September's year-over-year inflation are even higher at 3.0% for the CPI. Powell expressed concern that companies are passing higher tariff costs onto consumers, linking the geopolitical risks to the tangible economic data and highlighting the difficult path forward for monetary policy. Corporate catalysts, a new AI power couple, and sectoral shifts. The single biggest driver of today's market rally was a strategic partnership that reshaped the technology sector. The news of a collaboration between NVIDIA and Intel provided the primary bullish catalyst, sending shockwaves through the market. This represents a profound strategic shift for both companies, and its ripple effects are immense. NVIDIA announced it will acquire $5 billion of Intel stock as part of a collaboration to co-design and manufacture custom chips, aimed at boosting data center and PC performance. For Intel, this is a massive vote of confidence from the undisputed leader in AI chips, validating Intel's push into its foundry business. For NVIDIA, it diversifies its manufacturing base and allows it to integrate its best-in-class AI technology with Intel's foundational CPU architecture. The market reacted with explosive enthusiasm. Intel's stock soared as much as 28% in response, marking its best day since 1973. NVIDIA's stock also advanced by over 3%, emerging as a key driver of S&P 500 gains. This partnership could reshape the competitive landscape, putting pressure on competitors like AMD. More importantly, it signals that the AI boom is entering a new phase of consolidation and strategic cooperation, which is giving investors confidence to pour capital into the sector, directly leading to the Nasdaq's outperformance and the S&P 500's record high. Beyond the headline AI deal, specific corporate news stories provided powerful, sector-specific catalysts. In the healthcare sector, the divergent fortunes of United Health Group and Humana, both major players in the same industry, offer a perfect case study in how company-specific news can drive returns. Shares of United Health Group, UNH soared 8.6% after a favorable regulatory filing forecast that 78% of its Medicare Advantage members would be enrolled in plans rated 4 stars or higher. In stark contrast, shares of competitor Humana, plunged 12% after analysts reported that the Centers for Medicare and Medicaid Services, CMS, might adopt more stringent criteria for evaluating plans in 2026. Other notable gainers included Novo Nordisk, NVO, which climbed between 6.3% and 7.6% on positive trial results for its once-daily obesity pill, Wegovy. Coinbase Global, Coin, which advanced between 5.5% and 7.8% amid the broader cryptocurrency market roll. On the downside, shares of Albemarle, ALB, the world's largest lithium producer, tumbled 11.5% on news that a major Chinese lithium mine would restart production after being idle, renewing oversupply fears and putting pressure on the lithium industry. Additionally, steel company Nucor, NUE, fell 3.75% after cutting its full-year guidance. The broader M&A environment was also influenced by the Fed's action. The rate cut is giving private equity firms an opportunity to revisit shelved transactions by making acquisition financing cheaper. This was reflected in notable deals from the day, including Roche acquiring 89bio for up to $3.5 billion and Atlassian buying the AI startup DX for $1 billion. The digital asset landscape, the crypto rally, and regulatory maturity. The cryptocurrency market reacted predictably to the Fed's dovish pivot, with Bitcoin and other major altcoins posting strong gains. But beneath the surface, a more powerful structural shift is at play. The Fed's decision to cut rates boosts risk appetite, which historically benefits cryptocurrencies. However, the real story is the relentless institutional demand. Bitcoin, BTC, traded at around 117,460, up approximately 1.41%. Ethereum, ETH, saw an even more significant gain, rising nearly 3% to trade at 4,611.23. The total cryptocurrency market capitalization stood at approximately $4.1 trillion. The rally was not simply a reaction to the rate cut, it was a continuation of a powerful trend of institutional inflows. Recent data shows that net inflows into Bitcoin ETFs reached a record high, with institutional demand outpacing the creation of new Bitcoin by a factor of nearly 9 times over. This creates a powerful supply-side squeeze, providing a strong structural bullish signal for the final quarter of the year. Beyond price action, the industry is witnessing a maturation of its regulatory framework and a convergence with traditional finance. The Fed announced it is sunsetting its Novel Activities Supervision Program and will integrate the oversight of digital assets into its standard supervisory processes. This is a quiet but monumental shift in tone. It signals that digital assets are no longer considered a fringe, experimental novelty. Instead, they are being normalized and treated as a growing, but now routine, part of the broader financial ecosystem. The industry also saw a major partnership between two giants as Google and Coinbase collaborated to integrate stablecoin payments into a new, open-source AI payments protocol. This is a significant validation of stablecoins as a legitimate form of digital currency, tying the burgeoning crypto space to a major player in traditional tech and finance. Bullish, a crypto exchange, also secured a critical bit license in New York, a vital step for its expansion in the U.S. market. Conclusions. As a narrative of the events of September 19, 2025, a clear theme emerges. The market is betting on a future of powerful AI-driven growth and a supportive monetary policy environment. The tech-led rally and the surge in Bitcoin prices are clear indicators of this sentiment. Yet, this optimism stands in stark contrast to the underlying macroeconomic realities. The Federal Reserve's rate cut was framed as a defensive measure to combat a weakening labor market, not a signal of economic strength. The seemingly robust GDP number for Q2 was, upon closer inspection, a statistical anomaly masking an underlying slowdown in consumer demand. And looming over all of this is the political tension at the Fed and the persistent threat of tariff-induced inflation. The day's events remind that the market narrative is never simple. It is a complex interplay of optimism, policy, and data, a story of a confident market looking to the future while policymakers and economists contend with a delicate and unusual present. For investors, the key to success in the coming days will be in understanding not just the headlines, but the crucial contradictions that lie beneath them. And that's all we had for this video. Thanks for watching. If you found this video valuable, please hit the like button, subscribe to our channel. Just a quick reminder that this video is for educational purpose only and should not be taken as financial advice. For your personal financial advice, kindly get in touch with your financial advisor.